Arizona. You think sunshine, explosive growth, and, well, for a long time, rents just kept climbing.
Absolutely, that was the narrative.
But here's a bit of a curveball. Recent headlines, they're suggesting that script has flipped. Rent prices in Arizona might actually be falling,
It's surprising, yeah.
especially if you're living in or near, say, Phoenix or
Yeah.
Tucson. You might already be feeling this or hearing whispers about it.
Mm-hmm.
So our mission today is to really dive deep into why this shift is happening.
Yeah.
We've gathered insights from quite a few places.
We've got detailed market reports, hard data, and even, some pretty direct opinions from people actually experiencing it.
Right, trying to get the clearest possible picture of what's a pretty complex situation.
Exactly. We're going to pull back the curtain a bit on that interplay of supply, demand, and frankly, some other market dynamics that are pretty fascinating.
Okay.
We're pulling from reports, Clear Title Agency of Arizona, using CoStar data, some Globist analysis, and yeah, even digging into a Reddit thread to see what people are saying.
Getting the pulse of the market, really.
That's the idea.
Okay, so let's start with the current reality. Let's get grounded in the numbers. Phoenix first.
Sure. So Phoenix metro-wide, the vacancy rate, as of December 2023, it climbed to 10.7%.
10.7%. Wow.
Yeah, which is, a dramatic leap from just 5.1% back in mid-2021.
That's a huge difference. And what about the actual asking rents?
They've actually declined over the past year, down 2.6%.
Okay, so vacancies up, rents down in Phoenix. What about Tucson? Similar story.
Very similar pressures, yes. The latest data we have, May 2025, shows Tucson's vacancy spiked to 8.8%,
8.8.
which is up 60 basis points year over year, and average asking rents there. They really took a hit.
How much?
Plummeted 2.4% year over year in the first quarter of 2025, settled around $1,154. So what this means, for renters is that operators, the landlords, they're increasingly offering concessions. They have to deal with all this supply.
Concessions. Okay, let's talk about those. If you've been apartment hunting, you've probably seen these advertised, right?
Definitely. Free rent, gift cards, that kind of thing.
Yeah, and the numbers back it up. In Phoenix, by the third quarter of 2023, over 30% of multifamily properties were offering rent discounts.
30%.
Yeah, compare that to less than 10% back in 2021. It's a massive jump.
Huge change.
And we're talking real benefits here, like newly built luxury places, especially where there's tons of construction, like downtown Phoenix, Tempe.
Right.
They're offering 6, even 8 weeks of free rent. Moon Tower Phoenix was one specifically mentioned, offering up to 8 weeks.
8 weeks free. That's significant savings for a renter.
Absolutely. So this all begs the question, right? What's the driving force behind such a, dramatic shift?
Well, the main driver, pretty unequivocally, is just a massive construction surge, a building boom.
Right.
In Phoenix, just looking at the 12 months leading up to December 2023, they completed 17,000 units.
17,000.
Yeah. And that pace just completely outstripped the number of units actually being rented, the absorption.
So building faster than people are moving in.
Essentially, yes. And it's not stopping. On top of that, there were another 35,000 units under construction,
35,000 more.
which represents like 9.4% of the total existing inventory. It makes Phoenix, and this is a quote, one of the most aggressively built markets in the country.
Wow. Aggressively built. And this isn't just Phoenix, you said. Tucson, too.
Tucson's seeing it too, yeah. An unprecedented building spree there as well. They're forecasting about 2,400 new multifamily units to be completed by the end of 2025.
How does that compare?
Well, that number alone, 2,400, that exceeds the combined total from the past 2 years.
Okay, so a big acceleration there, too.
Exactly. And it's definitely expected to push Tucson's vacancy levels even higher.
So where is all this new supply actually going up? Is it concentrated?
It is somewhat. Downtown Phoenix and Tempe, for instance, they make up about 30% of the current construction pipeline.
Okay, targeting that young professional crowd. Live work play.
Seems like it, yeah. But it's not just the urban core, the West Valley suburbs, Goodyear, Buckeye, Surprise, Glendale. They're booming, too.
Right.
They've added over 10,000 units just since 2020. A lot of growth out there.
And there's that interesting trend out there, too, right? The build-to-rent communities.
Ah, yes, BTR. Very active, especially in the West Valley.
Explain those a bit. They're kind of a hybrid.
Exactly. They look and feel like single-family homes, layouts, maybe a small backyard, but they operate like a typical apartment complex, professionally managed rentals.
Interesting.
And what's really telling is that over a third of the new units delivered in the West Valley since 2020 have actually been these BTRs.
A third. Wow. Who are they attracting?
Seems to be attracting what they call renters by choice. People who could maybe buy but prefer to rent, and they're willing to pay a bit more for that single-family feel.
How much more?
Reports suggest maybe a 10% to 20% premium compared to traditional apartments.
Okay. So lots of building, different types of properties. How are these different segments holding up? Is everyone feeling the pinch equally?
That's where it gets fascinating. No, not equally at all. The majority of this new construction, maybe unsurprisingly, is focused on the high-end luxury stuff.
4 and 5-star properties.
Exactly, and even the 3-star segment to some extent. These are the ones really taking the brunt of this oversupply. Their vacancy rates have climbed sharply, over 400 basis points from their 2019 average.
400 basis points. Wow.
Yeah, and their rents are definitely showing clear declines.
But what about the other end of the market, like workforce housing? The 1 and 2-star places.
That's the counter-narrative. They've shown, significantly more resilience, much more stable.
How so?
Their vacancy rates have only increased by about 250 basis points from their 2019 average. Still up, but not nearly as dramatically.
Okay, a smaller increase. And rents.
Rents there actually held up better, too. The December 23 Phoenix report showed only a small decrease, like 0.8%. And then the January 2025 report even noted slight positive growth for workforce housing, like 0.09%.
So basically flat or even slightly up while luxury is dropping.
Precisely. It really seems like the market's segmenting itself. Different tiers are experiencing very different realities right now.
Okay, that makes sense.
Yeah.
So massive supply is clearly a huge piece of the puzzle. But, it takes two to tango. What about demand?
Right, the other side of the equation. And this is where it gets interesting because despite that huge supply surge, Phoenix has actually seen demand pick up recently.
Really? How much?
Well, in the 12 months leading up to January 2025, Phoenix recorded 20,000 units of net absorption.
Net absorption, meaning 20,000 more units were rented than vacated.
Exactly, which is a pretty significant number. It dramatically outpaces the pre-COVID 5-year average, which was around 7,200 units annually.
So demand is stronger than it was before the pandemic, even with all this building.
It appears so. And specifically, that 3-star segment, the middle tier, it absorbed 5,000 units after actually having negative absorption for years. So that's a big turnaround.
Okay, so why is demand picking up? What's driving that?
Well, connecting it to the broader economy, inflation has been easing somewhat. Consumer confidence seems to be rising a bit.
Right.
And that tends to reignite renter household formation. People feel more comfortable striking out on their own or forming new households.
And Phoenix's economy is generally strong, isn't it? Job growth.
Very strong. It added 43,000 jobs in the 12 months ending October 2023. That made it the 4th largest job growth nationwide.
Wow.
And you have those huge investments, right? TSMC's massive $40 billion chip plant bringing potentially 10,000 jobs. Intel's $20 billion expansion. Those are major economic drivers.
Okay, so this leads to a really interesting point, doesn't it? If demand is picking up and the economy is strong, why are rents still falling, especially in those higher-end segments?
Exactly. It seems counterintuitive based on traditional market logic. Strong demand should support rents or at least stop them from falling so much.
Which brings us to, well, a more controversial factor. Something else might be at play here.
Potentially, yes. And this is where the conversation takes maybe an unexpected turn.
Okay.
If you look at some online discussions, like on Reddit, you find users talking about something else entirely.
What's that?
They're pointing fingers at algorithm-based software, specifically mentioning one called LRO.
Okay, LRO software. What are they saying about it?
Well, the allegations are that major apartment owners have been using this software for, and these are the users' terms, price fixing or anti-competitive behavior.
Price fixing. How would that work?
The claim, or the theory put forward by some users, is that the software aimed to maximize profit even if it meant vacant units.
Maximize profit with vacant units? That sounds odd.
Well, one user explained it like this. Imagine the software suggests you can charge, say, 40% more rent. Even if that means your occupancy drops to 80%, The calculation might show you'd actually earn more overall profit than if you had 100% occupancy at the lower, older rate.
Ah, okay. So the algorithm might prioritize higher rent on fewer units over full occupancy at lower rates.
That's the allegation being discussed online, yes. That it could artificially inflate rents by encouraging landlords, collectively guided by the software, to hold out for higher prices rather than filling units quickly.
Now, is this just online chatter, or is there more to it?
Well, it's moved beyond just chatter. To be clear on the legal side, the Arizona Attorney General, Chris Mays, actually did file a lawsuit.
A lawsuit. Against whom?
Against RealPage, the company behind that LRO software, and several large residential landlords. This was filed on February 28, 2024.
And the allegation?
An alleged illegal price-fixing conspiracy, essentially claiming they colluded using the software to keep rents artificially high.
Okay, so there's an active legal case.
Correct. It's important to state, this is an ongoing legal situation. And even within that Reddit thread, opinions differ on how much direct impact this software or the lawsuit might be having on the recent rent drops we're seeing right now.
Right, correlation versus causation. The lawsuit alleges past behavior might have inflated rents, but the current drops could still be primarily driven by the massive oversupply we discussed.
Exactly. It's complex. But this legal battle definitely highlights how modern technology, even technology designed for efficiency, can introduce some really unforeseen complexities into how markets behave, potentially reshaping competition itself.
It adds a whole other layer to understanding the current situation. So, okay, we've got this huge building boom, shifting demand patterns, and now these legal controversies. What does this all mean for the future? Where is Arizona's rental market heading?
Well, the general outlook, based on the reports we looked at, suggests vacancy rates in Phoenix are probably going to peak sometime in 2025.
Peak this year.
Yeah. And then maybe a gradual recovery starting towards the end of the year. But meaningful rent growth again, that might take a bit longer. The market really needs time to absorb all that oversupply.
So stabilization first, then maybe growth later.
That seems to be the consensus. Stabilization and perhaps some renewed rent growth momentum expected more by 2026.
And Tucson, similar timeline.
Tucson's vacancy is forecast to end 2025 around 9%, so still elevated. That will likely lead to continued, albeit maybe modest, rent decreases there too. Hopefully not as steep as what Phoenix saw recently.
Okay, so a period of adjustment still ahead. But what about the long term? Should people be worried about Arizona's appeal?
I wouldn't say so based on the fundamentals. You really shouldn't overlook the powerful long-term drivers. Phoenix still boasts, nation-leading demographic patterns.
Kids are still moving there.
Oh, yeah. A growing and diversifying economy, that attractive quality of life. These things continue to stoke the underlying demand for housing.
Do we have numbers on that influx?
Yeah, get this. In 2022 alone, the Phoenix metro area saw a net influx of about 175 new people every single day.
Every day, wow.
Which made Maricopa County the fastest growing county in the entire country. That's a really strong foundation for future demand.
That's a powerful counterpoint to the current softness.
It really is. And connecting back to that Reddit discussion for a moment, one user made a really apt point. They mentioned that the Phoenix real estate market is just inherently cyclical. It has these big swings.
Ups and downs are part of its history.
Exactly. So while we're definitely seeing significant adjustments right now, a rebalancing is happening. The underlying growth drivers, population influx, job creation, they remain really strong.
Suggesting this is more of a phase, maybe a necessary correction within a larger dynamic cycle rather than some kind of permanent downturn?
That seems like a very reasonable interpretation, yes. The long-term fundamentals still look quite positive for Arizona.
Okay, so we've covered a lot of ground here. You've now gotten, hopefully, a really full deep dive into Arizona's pretty complex rental market.
It's definitely a dynamic picture, isn't it? Shaped by, classic supply and demand, but also these big economic shifts and, yeah, even these kind of fascinating tech and legal controversies playing out. So for you listening, whether you're maybe a renter looking for a better deal right now or a potential investor trying to read the tea leaves, or maybe just someone curious about how these market forces work. This deep dive, I think, really shows that even in super fast-growing areas like Arizona, these market dynamics can create some surprising opportunities, but also real challenges. It demands close attention.
Absolutely. And it leaves us with something to think about, maybe mull over after this. How might these kinds of shifting rental dynamics, this volatility we're seeing in a formerly red-hot market like Arizona, how might that influence things like housing affordability and community development in other fast-growing cities across the country?
That's a great question. Are we seeing a potential blueprint, or is Arizona unique? Something to consider.